great to be back here to give an update on what's a really solid result for our shareholders again. So we'll get straight into that. We've got the numbers in broad terms. So really great thing about this result, revenue up 20% to 387 million, NPAT up 32% to 33.7 million. And if you look at that compared to 2014, we've come up from 19.1 million. Earnings per share up nearly 20%, and paying a dividend fully franked at 18 cents for the year, which is approximately a 7.5% yield. It's a fantastic result, and it's a testament to the whole business, the whole VLW team, but really our business model of sticking to the core product of what we do. If we jump on quickly there, I'll just make a couple of comments about the strategy. We've been on a strong growth strategy in the last 4 years, and we're looking to achieve continued growth, but sticking to the core business of what we do. And that's affordable house and land in the growth corridors of our capital cities, Sydney, Brisbane and Melbourne. We are growing our joint ventures and capital light components of the business, which gives us a real focus on improving the return on equity. And we've now delivered 4 years of consistent performance, and our strategy is about continuing to build on that track record. From a portfolio perspective, we keep a 5-year supply. We're replenishing in Queensland, we're growing in Victoria and re-establishing the business in New South Wales. And as I mentioned, particularly working on elements of growing our footprint through partnering. In the long term, we have flagged, we see the business being 40% in Queensland, 40% in Victoria and 20% in New South Wales. And we'll get to that balance as property markets and opportunities allow us to. From a sales perspective, in the VLW business, it's all about sales. And we've been able to drive sales very strongly in the past year. We achieved 1,185 sales, which was at the upper end of our target range. In the coming year, we haven't set a target for our sales, but we have indicated that we will better our sales from this year. And it's important to look at what things are underpinning those sales, and it's all about low interest rates, consumer confidence and first home buyer grants that's generating our sales off a really broad customer base, but it is underpinned by owner occupiers and first home buyers are the core strength of our business. If we go on a little bit, and a couple of other comments on the results, and I think there's many slides in this pack that you can all look at that give all the details of our financials. And by all means, when you look through that material, talk to Marta or Pauline about some of those details. But the key things I want to say today is to highlight the growing revenues, the growing NPAT and earnings per share, the consistency of our dividend payment. We are paying out in accordance with our policy of between 50 and 75%. And you will have seen that we've been gradually able to increase that dividend payment while that ratio is coming down a little bit. The other highlights that you will get when you look at the financials is the strength of the cash flow of this business, and also the great flexibility that we have within our debt facilities and the strength of our balance sheet. So welcome you to look in detail at that as time allows. We thought this morning it was probably better if I concentrate on where the property markets are and some of the fundamentals that are driving our business. So as we've said, we see a strong continuation of the markets that we're in. The first home buyer grants in Queensland have been increased from 15 to 20,000, which is assisting our programs in that area. The market is being buoyed by the low interest rates. Previously, I was of a view that it was more consumer confidence that was driving our sales and that rates were so low they didn't matter. But we have seen the last couple of rate cuts drive people to action where they're actually out there doing things. The other thing really helping our sales is the big price differential between the Sydney market and Brisbane. We are starting to see that being a driver of property in Queensland again. With industry issues that are out there, things I want to really highlight of that, we have less than 5% of our buyers as international customers, and we have no product in the apartment space, which really differentiates us from a lot of our competitors. So they're real strengths of our business model. Our great financial facilities where we don't need to get pre-sales to start projects and we have good debt capacity available to us is a significant competitive advantage in the current marketplace as well. And I guess the all-important where we see things going to next year. We have carried forward sales of 464 lots, or nearly $166 million, which is a very strong start for the year. We're seeing strong sales across Queensland that we think will continue in 17. Victorian projects are contributing strongly to sales, and Victoria has really great population growth, so we see that continuing. In financial year 17, we start to see profits flowing through from our joint venture activities at Roachdale, which those capital light ventures give us a really enhanced return on assets deployed within the business. And we see a strong gross margin across the projects that we wholly own. I think we've been able to restock the portfolio to have all the product that we need to deliver our earnings in financial year 17. All the sites are owned and approved, and we're looking forward to rolling them out. We will spend between 60 and 85 million in the coming year on new acquisitions to replenish the portfolio, and about 40 million in our capital light ventures. Probably more importantly, we've got NPAT growth guidance out there of at least 5% on this year, taking us to 35.4 million, and we're forecasting at least an 18 cents per share fully franked dividend. So a really strong result and a good outlook in our space, and that's probably all I've got time for this morning.